Hello everyone. I hope everybody is fine. As usual, I am going to talk a very important topic today, and that is on the topic of business management. So, as all of you are aware that in the modern days, the business is going to come to the rescue of all the problems in the society. More importantly, the economic problems and the problems of unemployment. They all can only be resolved through business activism, for that matter. So the point is, the government is also making all kind of efforts to ensure that there is a lot of support for the people who are trying to have their own ventures and making user-friendly or business-friendly policy-making decisions, right from curtailing the corporate tax from 30 to 22 and so on and so forth. There are a lot of endeavors going on. Now, since business are established purely from the point of view of making profits, so it will be the dream of every businessman to pursue all the projects that are made available to them, because there are a lot of projects going on at any given point in time, and you as a businessman will definitely try to get all those projects so that you can maximize your profit and generate wealth in the process. But do you think it is possible, given the limited capital that you might have had? So irrespective of what is your level of doing business, definitely the capital available to you is also always going to be lesser than what you actually dream of doing. So how do you do it then? So therefore, capital budgeting is a topic for discussion today, which is basically a tool in the hands of management by which it can decide on the more profitable businesses and shortlist them so that they can pick and choose and start doing the project of their interest, which is going to give them maximum yields in terms of the return on investment. Okay, so today we'll be having a detailed discussion on various methodologies. There are a number of them, out of which I'll be discussing the discounted cash flow method in particular. Okay. So hi, I'm Professor P.K. Pathak. As usual, I'm again back and talking to you. I hope you must be enjoying all the video discussions that we have had earlier. And my request to all of you is to do like, share, and comment. Also subscribe my channel so that it gives me motivation to provide you such kind of videos in more numbers. And on that note, now I'll start sharing the slide. I hope you can see the slides. Okay. So this is discounted cash flow method, which is the topic of the day. So what exactly this is? As I told you, this is one of the method of capital budgeting. As already explained to you that ideally business should pursue any and all projects, but since there is a limitation of the capital amount, they will definitely use these techniques to determine which project will yield the best return over the applicable period. Okay. So these are some of the methods, like the discounted cash flow method, the NPV, that stands for the net present value method, also the payback period, IRR period, internal rate of return method, and throughput analysis. So in today's discussion, we'll just be concentrating on the first one, that is the discounted cash flow method, which is being widely used by all the businessmen to arrive at a particular decision while selecting some promising projects. So let us go ahead and find out what is the discounted cash flow method. You see, there had been a lot of government schemes prevailing in our country right from days when we were kids, and even now it is going on. Of course, the difference is that earlier the interest rate was quite high, and the money used to get double in a comparatively lesser period of time when compared to now. So even then, when somebody says that, look, whatever money you invest, it will get double in the next 5, 6, or 7, 8 years down the line. Do you really think that your money gets doubled? I have a doubt on that. Why? Because there is always a revaluation in money, then there is a rate of inflation. There are multiple other financial factors which do have impact on the, purchasing power of the money. And so therefore, the money which you are be having today, even if lesser in amount, it can be more productive than a more, numerically more sum of the amount few years down the line. So that's what it has been arrived at, that investment now is worth an amount equal to the sum of all the future cash flows in few years, with each of those cash flows being discounted to the present value. So what basically we are looking for, discounted cash flow analysis is, considering these three elements. The one is the initial cash outflow needed to fund a project, because when you are trying to get a project, definitely it will have some certain cost which you need to pay. Okay, so what will be the initial cash outflow in terms to acquire a project, that is of the prime concern, and how it will result into cash generation in times to come. I mean, every year there will be some cash inflows in terms of the revenue generation, which will also be having some part of the profit as usual. Okay, and other future outflows in the form of maintenance. So now you understand that any project will have multiple impacts. One is initial cash outflow, you are trying to acquire a project. Number two is the maintenance cost, which again is a cash outflow. The cash is going out of your company. And the most important element is the cash inflows in the process of pursuing that particular project. So these three elements are being considered in the discounted cash flow measure. Let us see further. So who are all the users of this? The businessmen use this method to identify or determine the fair value of most type of the investments. Also used by professional investors and analysts to determine how much to pay for a business, whether it's for the shares of the stock or for buying a whole company, and also to determine whether to give a project will be a good investment, like for a new product launch or a new manufacturing facility. So let us now understand in details what they mean actually. Can you see this particular figure? So in fact, these are the indicators of the cash inflows. If you invest some amount of money in pursuing a project, what is your main motive? The motive is to generate cash inflows also. You see, whatever investment you are making, the primary intention is to receive some revenue in the process. So suppose you have invested in some project and you have started receiving the cash inflows. Now, what is the difference and why we should use the discounted flow method is primarily because of this reason. If you see these dark blue lines, they represent the cash inflows. Okay, so you see, today you have invested in some project. After at end of the 1 year, you have received certain inflows. Okay, so the money by that time has reduced its value. So if you convert them into today's value, you will see that it has got lesser value than what you actually seem to suggest. Okay, so today, whatever, suppose you have 100 rupees, after 1 year, 110 rupees will be equivalent to 100 rupees because of the inflation and various other factors. So next year, suppose you have received 110 rupees, just let us imagine, then it will be just equivalent to 100 rupees. I'm just trying to, give an example that the amount that you receive is having lesser value if compared to in terms of the today's value. Similarly, at the end of the 2 years, if you receive this amount, it will further go down, and the realistic value in today's terms, it will be only this. So if you continue like this, the third year you receive here, the fourth year it comes here, fifth year like this, and so on and so forth. So much that after a few years down the line, although the figure may suggest that you are having a huge amount of money with you, like you can see here, it's a really big line, but the actual value in terms of the today's valuation, it is very low. Okay, so while this may be superficial, the amount that you just see in numeric terms may be superficial unless and until it is converted into today's value. Okay, So these are all the realistic figures. So if you add them up, you can see what will be the total cash revenue in terms of the today's value, and which is what is the point of reference or the comparison comparative parameter uh, uh, with reference to today's investment that you have to make. Okay, so let us understand it further. In terms of the equation, you can just make a note of it. You can keep a pen and diary with you. This formula is going to be most useful to you. So what is this? DCA, discounted cash flow. So the discounted cash flow for all the cash inflows that you have been generating over a period of time, this could be calculated like this. CF1, that is the cash inflow in the first year. And at the bottom, you have 1 plus R to the power 1, because this is at the end of the 1 year. Similarly, CF2 by 1 plus R whole square plus, and you can carry on. CFN in the nth year, you have 1 plus R to the power n. Okay, so for example, if we are calculating for the 10 years, here the value of n will be 10, here it will be 10, and 1 plus R to the power 1 plus R to the power 10. Okay, and these are the references which you must note it down. So DCF is the sum of all future discounted cash flows, and cash flow is the total cash flow for a given year. Okay, R is the discount rate in the decimal form. Decimal form का मतलब ये है कि divided by 100. Okay, and this is the target rate of return which you expect. And why do you expect this target rate of return? That will be having a discussion in the following slide. A very simple example, this will make it more clear. So if we start, if somebody is asking you, offering you $1,500 in 3 years, he says that, look, you give me some amount of money, okay, and I'll give you so much of amount. So he may be demanding 1,000 or 1,200 or 1,300, whatever. But he wants to give you after 3 years, $1,500. How much money should you give? And this will depend on multiple factors. Okay, so the point is how much you are willing to pay for the eventual reward today. How much would you offer? So for that, you have to put the equation. You have to translate that 1,500 into the values to you today. Okay, 3 साल के बाद $1,500 की जो value है, if you convert into today's value, definitely you should give less than that. Okay. So this has been calculated for your simplicity. If you had $1,000 today and compounded it at 14.5% per year, it would be equivalent to $1,500 in 3 years. Okay, the calculation in the as per the previous formula, it will give you this thing. Now that means what? If you pay him $1,000, expecting that you need a return of 14.5% per year, then it's okay. But if you have to give more than 1,000, that it will definitely be loss. Now the question is, how do you arrive at this 14.5% of figure? You say you will definitely invest in some business activity when you know that you can generate more profit than what is obvious to you. So say for example, if you put this amount in a bank, how much money do you expect to give? How much return they are giving to you? Maybe 4%, maybe 5%, maybe 6%, depending on the risk-free, return that you are getting, and that is purely because you have deprived yourself from using that money for so many years. So in this case, you have deprived yourself of using 1,000 rupees for 3 long years, and for that you must be rewarded in terms of the returns. So in case you are getting it from bank, your money is safe. There is no point. So you are getting, say, let us take an example of 8%. But you don't want to just get that less amount of money. You want to enhance your profitability. So what do? You take some amount of risk. So you have taken a risk and you have invested in the market. In this particular example, your friend has offered you. So there is also a risk that he may run away with your amount. So for that risk, you also must calculate something in terms of the higher returns. So 8%, the bank rate you must receive. Then you must also add on some risk element, some higher profitability, and all this will give you some amount of idea that, look, if you are getting 14% or 15%, you will be comfortable with that. So that should be your own assessment, and your assessment could differ according to the different circumstances. So somebody else may feel that, yeah, look, 12% is fair enough, return. So depending on that, the amount will vary. Okay, so this is one of the example. Let us go ahead further. Now this is, you can see the bottom line. You can buy an investment for a price that is below the sum of discounted cash flow. You may be looking at an undervalued and therefore potentially very rewarding investment. So look at here. If you are seeking a return of 14.5%, you need to pay him $1,000. So now what if you can just negotiate and make him agree to just pay $950? So you are more beneficial in this case, and you must definitely go with this proposal. But what if that individual is sticking on that you must pay him $1,100? Then you should reject the proposal. Why? Because your rate of return will only be achieved if you are giving him $1,000. If you have to pay $1,100, definitely your expectations are not going to be fulfilled. Okay, so this is the bottom line. Now here is another example how to determine the fair value of a business. So for that, you just have to look into all the details. This is an example. Suppose you were offered a private deal to buy a 20% stake in a local business that has been around for decades, and you know the owner well. Other respect, credibility is not in question. You know the owner well, and the business is going to go, it is going to flourish. And there is a proposal that you may buy 20% stake in that particular business. Okay. Now let us further identify what are the details. The business has been passed down through 3 generations and still going strong. Again, this is the point of credibility. But growth rate of the company is only 3% per year. Okay, so 3% growth year का मतलब ये है कि if you invest 100 rupees, next year you will be receiving 103 rupees. The growth is only of 3%. Now, what is the status today? It currently produces $500,000 per year in free cash flows. So, if 20% of this you have to buy, इसका मतलब ये है कि every year you will be receiving a cash inflow of $100,000. Okay, and this is likely to grow by 3% per year given the past record. Okay. So I think this is clear to all of you. Once again, I'll just repeat it very fast. 20% stake you are supposed to get. The cash inflow per year as of now is $500,000. So 20% means for $100,000 you are going to receive as a cash inflow, and add to that the 3% annual rate of growth. So let us see what it translates into. So this year the business will give you $100,000. The next year with 3% growth it will give you $103,000. Similarly, it will give me another figure in the next year, and so on and so forth, with the same rate of growth. Now, as already you know that stake in the business is what an amount of money equal to the sum of all future cash inflows. So today, whatever you are paying, it must be slightly less than what you are expected to get in all your cash inflows in all your future years. Take a sum of all that converted into today's value. Okay, so fairly discounted at the present value. So let us say, since this is a private business deal with full liquidity, let us say your target compounded rate of interest is 15% per year. As I told you that there is a risk element involved when you are investing in a business. So just to mitigate the risk, you are seeking a higher rate of return. So let us suppose that you are seeking a return of 15%. Okay, so that is the rate also because you can earn this 15% on other equivalent investment. So you would only buy this business stake if you can get equivalent to this 50%. Okay, so this would be your standard expected rate of return. With that, we'll proceed further. So putting the values in the equation, what do we get? DCF we can calculate like this, putting the formula into perspective. So CF1, then this 1 plus R to the power 1 and so on and so forth till nth year. So this is the formula. And whatever value that you get here, that should be the maximum amount that you should be paying it to buy it today. Okay, because you can generate more than that. So that should be maximum. If we can, bring it down just by negotiation, it's okay. So let us just see for the first 5 years what happens. The actual cash flow, as I told you, in the first year, 100,000, but discounted cash flow, it gives you only this amount of money because you are putting it in perspective. Or DCF का आपने formula apply किया. So here is the cash flow. You divide it by 1 plus the expected rate of return, that is 15% to the power 1, and the resulting amount is only 86,957. Next year, situation is even more worse. So you just happen to get 77 in the real sense. So similarly, if you calculate, you can see in just fifth year itself, whatever you think that you are getting, maybe $112,000 to be, roughly on the round figure. The amount actual value is just half of that amount, almost half of that amount. Okay, so this is a superficial figure. Therefore, if you just look into this, okay, so how much actually you are getting in terms of the today's value? While you may think that you are getting 100, 200, 300, 400, 500 and almost 530 plus dollars, you seem to get. But ultimately, if you see, the calculation is much below that. So if we just prepare the chart like this for the past 25 years, you can see that while the cash inflows, in numeric terms, it happens to be, looks to be quite big. In the real sense, it is very low. So much so that it becomes negligible in the last parts of the years. As you can see through this particular graph, I have already explained you. So let us say, for example, the first year you have received $100,000. The value is only 86. The next year you will receive $103,000. The value is even lesser. The next year again you receive some more amount, but value is more or less, and like this you can see. So if you, even if you receive $200,000, which is appears to be the double of the amount, the actual value is much lesser, and it almost like negligible in the 25th year. So unless and until care for these light lines, light colored lines, I think you cannot flourish in the business, because simply you have taken the things wrong. Okay. So let us sum them up. For example, on year 5, you were expected to receive $100. This I already have explained you. So as the discount rate 15% that we are applying is much higher than the growth rate of the cash flow, this is the inference we can make. The discounted version of those future cash flows will shrink and shrink each year, and it approaches to 0. So therefore, although the sum of all future cash flows, that is the dark blue lines, look at here, dark blue lines, okay, appears to be a bigger amount, but here the actual amount that you can receive is only this much amount, $784 to $86. Okay, so the inference you can make here is that even the company is being shut down after a few years down the line, maybe 25 years down the line, even then you are okay, because you have recovered the whole amount of money that you have invested. Okay. So coming to the limitations, we can say that making assessment, making anticipations and calculations, they are comparatively easy than actually being able to predict the future, because it may not happen exactly the way you are looking for, and you are looking for in a very long-term perspective. So the things can go wrong at any point in time. As the Faraday's law says, if something can go wrong, it will go wrong. So if you do not know the future, how will you know and anticipate in the correct terms what will be the cash inflow? And anywhere, if we have miscalculated, the whole planning will go on the reverse. Okay, so the problem is that your estimate of future cash flow only is anticipatory, and projects may fail, and things could be in a very different scene. Okay, so what is the way out now? To sum up now, we can say what the investors do. The experienced investors, what they do, they apply a margin of safety. So suppose your DCF comes out to be $50, for example. Okay, so the discounted cash flow method, if you know that $50 is the work that you can pay maximum, you must negotiate to get it in $45 only. So even if your calculations go wrong in some place, you'll be fairly comfortable. Okay, similarly, if you calculate your DCF is $1 million, you should only offer $900,000. So this is the factor of safety. Okay, so margin of error के लिए भी you will be have enough space. चलिए. Secondly, what you can do is you can diversify your portfolio. So if you split your wealth into multiple projects, so even if one project is giving you some loss, the other project will definitely make good of it. Okay, so ultimately the risk is mitigated because all your risk have been divided into multiple businesses. Okay, so when you combine these two methods, definitely you will emerge more victorious, and in all probability you will be end up making huge amount of profits. Okay, so this is all about the discounted cash flow. I think you have enjoyed. You have known that barely looking into the to the very high figures in terms of the future cash inflows is not going to give you the realistic figure, and what you need to do is you need to convert them into the today's value to be very realistic and to be very judicious. And you can see there is a huge difference in what you actually receive in numeric terms and what you actually get in the real terms. So you must be cautious, and if you apply this discounted cash flow method, definitely your project selection decision is going to be much better than what it could have been without the use of discounted cash flow method. So in the next video, we'll be coming up with the another types, that is the NPV method, net present value method, and the payback period method, IRR, that is the internal rate of return, and the throughput analysis put together. Okay, so on that note, I thank all of you for watching the video so interestingly. Do like, comment, share, and subscribe to my YouTube channel for more interesting videos. That's all for the day. Okay, and once again, thanks a lot for watching my video. Stay tuned, and we'll be back